Welcome back. Well, we are in the thick of results season, and today it was a very good set of numbers that we got from Yes Bank. That's a bit of a habit. They have been surprising on the positive with their numbers. Just to read out, the net interest income grew by 27%. We haven't seen that in too many banks. And the net profit as well grew by 27% to 702 crores. I'm only reading the fourth quarter numbers. Perhaps a complaining point could be the gross NPLs, which rose by about 1%, by about 10 basis points. It's not a great deal, but the point is that you did see a rise in NPLs, something which we are not used to seeing in Yes Bank. But to put the entire picture into perspective, I have with me the big man himself from Yes Bank, Mr. Rana Kapoor, Managing Director and CEO of Yes Bank, joins me in the studio. Mr. Kapoor, thank you very much for joining me. Well, we're actually trying to find fault with what is otherwise a very good set of numbers. Let me accept that. Let me come to the NPL picture itself. You have said that all that RBI said in its asset quality review is already recognized by your by the bank. What is the future picture of bad loans? Do you think you stop at 0.76, or do you think FY17 and FY18, because of the nature of the economy, can still throw up 10 basis points more?
I think the nature of the economy is going through a fundamental improvement. I think the regulatory environment which is enforcing some of these decisions, including AQR and early stage recognition, is also making its own contribution to problem solving and troubleshooting. So when I look at Yes Bank, I am very pleased to report to you that even at 0.76% gross NPA and net NPAs of only 0.29%, on a bank which has still 65% corporate balance sheet, it's a better outcome than most retail banks, even after struggling for the last 8 years with the global crisis and all.
So what is your secret? If you are 65% exposed to a corporate sector, which for everybody else is, throwing up probably 15% of bad loans, how is it that your 65% is producing less than 1% of bad loans?
No, Lata, I think the solution, and I think, lies in building a risk culture and building a risk architecture and building a 3I principle, which at least in our bank is defined as relationship managers, product managers and risk managers, who all look at a relationship from all angles, right? And that makes sure that when you have a problem, the red flags surface early enough. And second principle is that risk is related to structure. This is not a commoditized business. This business is about specialization. So depending on the segment, depending on the industry sector, banks need to specialize. So I'm very pleased to share with you that after 12 years, Yes Bank is and proven over the last 32 quarters since the global crisis started, that we are committed to building the risk architecture through specialization. And therefore, yes, everybody is affected by the heightened risk environment, but more importantly is how do you salvage that? How do you proactively de-risk? And not everybody is it's not a willful defaulter.
No, that point. I mean, I take that point.
There's some very genuine problems, and you have to help them through preservation of economic value, preservation of assets, and most of the businesses, 90-95% are good businesses.
Okay. I'll come back to the corporate facing part of your book, but before that, the retail facing part of your book, you said it's 35%, and you're progressively going to take it to in FY17-18.
Our objective is in 2 years from now, we should take it up to at least 45%. And by 2020, it should be a good 50-50 balance, because we see opportunities for a bank like ours, with the brand resonating, with the kind of momentum, with the investments we have made in branch infrastructure, in terms of people. Almost 80% of our 15,000 people are actually deployed today in retail and branch banking. So by 2020, we should be equalized between the two mainstream businesses.
So now if you progress from 35 to say 40% by FY17 or 18, won't that tell on margins? Because retail, after all, gives lesser margins.
Well, actually, retail, if you have a good wallet strategy, if you have a good cross-sell strategy, and if you're cross-mining a client into selling multiple products, it becomes a very profitable business. If you have monoline businesses selling singular products, it can be a value destroyer.
So you think this 3.4% can be maintained even if you become substantially retail?
No, 3.4% has to get much better in terms of net interest margin, because that's where we are right now.
No, that's what I'm saying. You are at a 3.4% net interest margin.
Yeah.
If you get retail,
Yes.
Is that margin likely to come
I think
down?
it's going to improve, because what happens is that, the overall cross-sell really helps. The credit outlay on retail is far less because of the overall capital consumption being less. And thirdly, what it does is it creates also a liabilities multiplier. So the CASA cost also comes down. So you have to look at the totality of the retail and the SME proposition, because when you look at the entire pie, it's a very profitable pie.
Okay.
What it needs is scale. What it needs is momentum. What it needs is brand, because this has become like a FMCG business. So yes, with this brand resonating rather well, is in a position to grow this, and with the right product mix and making sure that we don't bring in any value destroyers in the business.
Okay, what will your percentage of low-cost deposits be in FY17? At the moment, your retail deposits are growing very well, but what is the percentage to total?
Lita, today I reported earlier to your channel that our CASA has grown 5% in 1 year, from 23.1% to 28.1%, right?
Yeah.
Which is our single biggest leap forward in 1 year. Number two, the momentum of retail CASA plus FDs is now almost 54.5%, which is a 6.6% improvement year on year. So we are on track to get to about 40% CASA in approximately 2.5 years, far ahead of our original program. We are targeted by 2020. I'm hoping that sometime between 2018-19 we get to 40% CASA, and that's a sweet spot as far as the liability cost composition is concerned.
Okay. To come back to the corporate facing part of your book, can you tell us something more about how much is in the SMA 1 and in the SMA 2 category,
Yes.
to reassure investors as to the future course of difficult assets?
See, when you look at the sequence of credit quality, naturally your earlier question, you look at NPAs, you look at security receipts, you look at the restructured portfolio, and SMA 2, which is like a watch list category, in our case is just about 1.5%
Of the total corporate book?
of the total, total loan book. The fact of the matter is that SMA 2 is a watch list. It's not like, these people are falling over the cliff. That in a economic situation like ours, and with the, very dynamic, regulations, that some of these customers need to adjust to best practices.
Yes.
So I think the best practices that have been introduced by Reserve Bank of India, supported by, other, stakeholders, is a reflection of building credit discipline, financial discipline, and to me this is a very important principle. So I would not be bothered about SMA 2. I would be more bothered about what is happening to security receipts, who's dumping where, and restructured loan portfolios, and are we able to collect NPAs, because that's really where the ability of a bank's credit competence lies, its relationship and its tactics lies, and fortunately in our bank we are doing reasonably well.
Yes, your restructure advances in any case is not very big, which is why
and it's come down marginally from 0.67% to 0.53%.
Yeah, so that's why I didn't bother so much about your restructured book.
Sometimes you have to share the good news also.
No, that has run through the day. It's just a few doubts that I had, which I wanted to clarify with you. Also, your exposure, we know the big 10 indebted groups. What's Yes Bank's exposure to those groups?
Well, the big 10 groups are very important groups strategically in our country. And if they're going through duress, some of them, not all of them, and they are able to monetize assets, we have to understand that, risk is related to structure. So most of these groups are parking their best assets to salvage future value monetize future value, there's preservation of asset quality, and I think there's an unnecessary psychosis in the system to worry about these large conglomerates because the intent is very good. There are business cycles that they are facing, which are of creating some setbacks. But the fact is, there's also revival around the corner.
I completely take your point. It's not as if they're NPLs, but it is just that they're indebted groups. So I just want to know clinically. I'm not passing a value judgment on the number. Clinically, how much would that be?
Actually, overall, as you know, our corporate exposure is 65%. The large group concentration is not so much.
Okay.
And within that, please remember, every group in our country, because they are conglomerates, right? So they have, good quality assets.
Of course.
And maybe one or two or three which
difficult
are going
assets,
through,
absolutely.
which are difficult. So it depends on where you are parked and how you are structured.
No, I completely take your point. I'm not definitely trying to come to a conclusion about the quality of assets. You have told me that you're not expecting your NPLs to go up.
The problem in the Indian banking system is usually in the middle. And the small businesses. Because the larger businesses have a lot of asset values, right? And they preserve.
How much would it be, sir? 5%, 6%?
In our case, it's anywhere, certainly less than 5%. Yeah.
Okay, exposure to these groups. Okay, the other important question I want to ask you is tie-ups. There are the small bank finances. That is the easy route to retail. Will we see you buying up any of the smaller NBFCs, MFIs, anything inorganic?
I think it's a very good question. In our case, we have an aspiration to build through quality filters, through process management and systems management, our own outreach, because we have got enough frugal systems to be able to outreach, and we got also frugal technologies to back that. So the primary thrust in the bank is to build in-house organic strategies. Second point is, yes, there will be opportunities for alliances with small banks, alliances with microfinance institutions, maybe selectively also with some telcos, with e-commerce companies, asset management companies, insurance companies.
But those are tie-ups, not strategic investments or mergers. Would that be on your radar?
No, actually what we believe is that we need to be agnostic and to participate in a larger B2B community and a B2B2C community. And I'm deeply convinced, as is our leadership team, that we have the ability to scale our model on our own, one, and two, through alliances.
Okay. So inorganic will not be...
You know why? Because the quality filters are very important. Sometimes you can get a good deal to buy someone, but then it creates a culture which has...
There are quality MFIs today, you will have to admit. So
yeah, they are definitely bouncing back, and we are lenders to most of them, and we are very happy with the quality of the risk there.
Okay, so you're not looking at an inorganic relationship.
I think we can build it on our own.
Okay.
At a lower cost.
Okay. Finally, since you are, a very close observer of the economic scene itself, how does it look to you while your bank has not borne the scars of the economic downturn? Is the economy itself turning around? I mean the sticky sectors, steel, power, roads, infrastructure.
No, let's, if you do a stock take, compared to one and a half years ago, if you look at each of the sectors you mentioned, I can tell you there is a renaissance in roads. There is definitely a transformational shift when it comes to even the thermal power business and the new opportunities in the renewable energy business. When you look at the opportunities for urban infrastructure, there is smart city driven strategies, I think there is new growth opportunity there. So I think what we are looking at is a very significant correction of the past manifesting itself in future opportunities for banking. It's just that there have been some gestationary skeletons in the banking system, which because of lag effect have got somewhat delayed. But for banks who have been proactive, I think there's an opportunity in adversity to grow and grow with quality with the right filters in place.
You've described yourself very aptly. Thank you very much, Mr. Kapoor, for joining us in this discussion. Well, that's it on this special chat with the Yes Bank head, Managing Director and CEO, Mr. Kapoor. We take a short break and we are back with more news updates.